Hey, my name's James Nicholson and welcome to my YouTube channel. It's a double whammy this week. We have a second central bank that has dropped interest rates. This is one of the big three. So the big three central banks are the Bank of England, the Federal Reserve and the European Central Bank. Now, the European Central Bank have dropped rates. They've also indicated how many more times they're going to drop rates this year, which is really positive as well. So I'm going to talk about that. And the markets have already reacted to how much they feel the Bank of England now will drop rates. So just because you're not in Europe, this impacts you. And this is a positive step. We needed someone to drop interest rates first. We had Switzerland do it earlier in the year. We've now had Canada do it yesterday. But the European zone is one of the bigger players in this. And them dropping today is really good because it takes off the pressure from the Federal Reserve and the Bank of England. They've also said inflation is likely to increase in the Eurozone, but they still feel they need to go ahead with cuts. That's an important message that we've got from today as well. So before we jump into this, as always, if you haven't done already, do subscribe to the channel over there and hit the bell notification. We're on the way to 25,000 subscribers. We could hit it this week. If you help, you'll see how close we are to that. And while you're here, smash like, tickle like, hit that like button. Whether it's out of love for the channel or anger, do something to that like button. That really helps with the YouTube algorithm. It means you're an all-round good person if you do it. So what's going on? So this is the ECB, the European Central Bank. Now, they've had their rates at 4%, significantly lower than ours. I wish we were at 4%, don't you? But they've been at 4% for a while, and they haven't dropped interest rates since 2019. So it's been 5 years that they've kept interest rates high or increased interest rates. So today they've dropped the rate and it's gone from 4% to 3.75%. We covered this yesterday, didn't we? When we spoke about Canada. I think everyone is just going to do a small drop initially, just to see what happens and show willing to the markets that they're starting the process of dropping rates. So I don't think you're going to see anyone knocking off 1%, 0.5%, 0.75%. And if something drastic or really bad happens to our economy, that could change. But right now we're at 3.75%. That is good. So what's going on in the European Union? So they're saying inflation for those guys is 2.6. It was lower. That is increased, which is interesting. They feel that their annual inflation for 2024 is going to be higher than their initial prediction. They feel that it's going to be 2.5%. So this is inflation. They're saying in 25, it's still going to be above their target. This is interesting, right? Because they've all got this 2% target. And it's interesting, if you actually go and see where did this 2% target come from, the history of it, someone just plucked that number out the air and said, oh, that sounds quite good. That's a true story. Go and have a look at that. It defies belief. So they are saying that next year, we're also in the Eurozone going to be higher than the 2%, but they still think they need to drop rates to stimulate the economy. So next year, they feel the average for the year will be 2.2%, and they've gone out to 2026 with the data here, so no more data after that, but they feel 2026 is 1.9%. So that brings you below that 2%. So they're looking at averages, I guess. So if we stick at 1.9, maybe it brings it as an average down. So that's potentially good. And it's quite hard to hit 2% right on the nose. So that's positive in my opinion. I think people can cope with 2%, especially when wages have been going up slightly more than that. So it's when it's 12, 15%, or some food stuff was 40%, 50% on some items, that's when people really suffered. But if we can keep it 2.5%, 3% even, but we're getting pay rises at 4.5%, we'll catch up. I know they don't want that wage catch up, but that's what it is. So this was predicted by the markets yesterday, with 92 to 93% of people believing that rates will be cut. So that gives us some interesting data. So when the Bank of England next do their meeting, we can see, okay, what do the markets expect? Is it 50-50? Is it 100%? Is it 80%? Let's see where we go with that. Now, the European Union or the ECB have said they're also expecting to cut rates 2 more times this year. And they've even given us the dates for that. They're expecting to cut rates again in September and December, which is good. They've got their path. They're saying this is our goal. This is where we want to move forward. And they're also saying it depends on inflation. So if something shocking comes through in the inflation data, the September one might get kicked back to October or November. But that is the path at the moment. If everything stays on track like they're expecting, they're saying when they're going to cut rates. And that's good. And that's what we want to work on. Now, the Bank of England, the markets have reacted to this. What's the Bank of England going to do? So the Bank of England is now expected to cut rates, twice. We're expected to see 2 interest rate cuts in the year of 2024. Now, unfortunately, almost no one expects that the rate cut would be in June. But the markets did say if we didn't have the general election, that there's a fairly high chance that we would have cut rates in June. It's purely down to the fact that Rishi called that snap general election, that has been put back. Now, the 2 cuts are expected to be 0.25% each time, taking us down to 4.75%, which is not ideal. And at certain times this year, we were expected to be there by now. But the fact that the European Central Bank is still cutting rates while their forecasts for inflation are going up is positive, right? What the markets are saying as well, it still is highly dependent on the Federal Reserve because the pound is quite strong. Because of this, you can get $1.28 to a pound right now, which is not bad. But if the Bank of England was to do multiple cuts and the Federal Reserve did not, the pound would massively reduce in value, and that could cause another spike in inflation, which isn't great. So it's interesting to see. I feel that we might see some mortgage movement because, look, at the end of the day, who cares what the European bank rate is, or the Federal Reserve, or the Bank of England rate? All I care about, and probably all you care about, is how much is your credit card interest and how much is your mortgage interest, right? And so I think that we will see next week some reaction to this. I'm not sure. It could be that nothing, but I think we'll know fairly quickly if the swap rates, which is the rate that the banks borrow at, if that drops, then you could see some good deals next week. So keep an eye on that. It's possible that we could see some better rates next week. Of course, I'll bring that to you as and when that data comes out. But all in all, although it's not the Bank of England, this is good. All the banks are intertwined with each other. So the fact that this is one of the big central banks has gone now is positive news for UK mortgage holders. Let me know your thoughts in the comments below. Do smash like, do subscribe, help me get to 25,000 subscribers, and go and check out some more content on my channel, including this video right here.